So have a good long-term goal, but then think short and midterm. What are short-term goals that could help you achieve the larger long-term goal? I would almost say, and I actually will say, that if I had to choose between a short-term goal and a long-term goal, I'd rather pick a short-term goal because it's more into my control and have the sense of urgency of what I'm going to be able to do this quarter and this year, as opposed to 20 years from now, I want to have 50 properties and be wealthy.
Welcome to the Wealth Through Real Estate Investing podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and reach the lifestyle you always wanted. And now your host, Dwaine Clarke.
Hello and welcome to the Wealth Through Real Estate Investing podcast. This is your host, Dwaine Clarke, and today we have Christopher Calandra. Christopher is the founder and principal of Elliott Wealth Management Services, which has offices here in Southington, Connecticut, which is near my hometown, and Summerfield, Florida. Christopher is a certified financial planner with over 27 years of experience helping small business owners, retirees, and families achieve their financial goals and objectives. Christopher, thank you so much for joining us on the show. And how you doing, my friend?
Oh, it's a pleasure. We've planned this for a while, and I'm so happy that we finally were able to get together. I'm really looking forward to our chat today.
Absolutely. And I didn't realize that we're, pretty close to your offices in Southington, and I'm in East Windsor. So it's really good to actually talk to someone that's local for a change. We talk to people all over the country, but nothing here in Connecticut. So that's awesome.
I know. For listeners, when you host a podcast, I host a podcast, the Simply Financial podcast. And when you're a guest on other people's shows, more often than not, it seems like people are far away. So this is special that we're neighbors.
Exactly. Absolutely. So it'll be interesting conversation. We'll definitely have to have some coffee or tea at one of these days. So
no doubt.
So for people who are not familiar with, I know you've been in the business for over 27 years, tremendous amount of success. But for people who are not familiar with your background, would you mind taking a few moments to talk about how you got started and a little bit about your business?
Sure. So I'm a certified financial planner, like you said. So my practice, Elliott Wealth Management Services, helps individuals, families, small business owners make smart financial decisions. Our role is to help them win with money, build wealth, accomplish their goals. We have a specialty investing in traditional markets like stocks and bonds, mutual funds, ETFs. And we do a lot of tax planning, financial planning, like mapping out how retirement would look down the line. How much do you need to save? What are you projected to have for income? Things like that. We're a smallish firm, Dwaine, so we have a good, strong personal relationship with our clients. We don't have thousands of clients where you're nameless, faceless client relationship. We know our clients, and I have done this my entire career, which is now 27 years. It's one of those great things, Dwaine, like, wow, I have all that experience. But then again, I'm almost 50 now, which is, it's hard-fought experience. And part of the reason why we're going to talk about what we are today, the 7 wealth building rules for real estate investors, is that I believe that investing in real estate is an important part of the wealth building process. And I have invested in real estate myself since I was a young man, having bought my first property when I was 22 years old. And I bought a condo, and I purposely bought a 2-bedroom condo. I was single at the time, of course. And then I rented out the other bedroom to friends, and at one point my brother. But rented out that other bedroom to offset my mortgage cost, and I ended up living there almost rent-free, which was great. Was able to build some equity in the property, which was wonderful. Plus, in those early years, I was hanging around with my buddies, and that was pretty good too. Not great wealth building, but that was a lot of fun.
Yeah, definitely. So when I had kind of just doing some more looking about more information about you, reading through your thing, I found like you had mentioned a great white paper that you've written, the 7 wealth building rules for real estate investors. I get a lot of calls through our brokerage and investment side of our business. And we, they always get referrals from financial advisors saying, I want to add real estate as part of my portfolio. They want to get educated on it before kind of moving forward in concert with the team, financial advisor, attorneys, and things like that, which is one of the bullet points of your thing. So to kind of go through it, maybe we can talk about how we're talking about now is building your team. Like what's important as far as having a financial advisor, real estate broker, but what other stuff that you suggest that people should be, taking on as far as, the steps on building wealth through real
Sure.
estate?
I think in wealth building rules for real estate investors, number 4 is build a team. I know, Dwaine, you've talked about this with other guests, including recently Gary Lipsky. I think I'm pronouncing that right. That was a great episode. And also with Liz Faircloth. So you want to build your team. This is not an individual sport, not just real estate investing. I'll broaden it out to building wealth. If you want to build wealth, and money is not the most important thing in life, but it's important, and all of us work and strive to build wealth for security and to live a good life. So you're going to need a team. And so in the realm of real estate, that would include real estate agents, inspectors, an attorney, tradesmen to help you fix properties, plumbers, electricians, that kind of thing. But additionally, and this is a biased opinion, of course, having a certified financial planner that can help you map out and help with smart financial decision making, I think can and should be part of a team. Having a valuable CPA is another good example. I know my CPA has been a great ally for me for a long time. And I picked a CPA that's not just any CPA. It's a CPA that specializes in small business owners, and in particularly small business owners that have a portfolio of real estate investments like I do. And that teammate has been really, really valuable for me over these years. So you want to build a team. You can't possibly know everything. You're going to need some help. That could be partners. It could be syndicate partners, or, you and one other person decide to buy a real estate investment property, or it could be you sitting down with a financial planner, establishing your goals and figuring out how much of your wealth is going to come through real estate, whereas other parts might be 401ks, college funds, an emergency fund in the bank. So you definitely need to build a team and find valuable people that you trust, that understand your goals and objectives, and can play a role in helping you achieve those goals.
Yeah, that's kind of hit the nail on the head there. It's kind of, people think like, I need to go buy real estate, but then, they need to know the goals. If you have children, kids are going to college or retirement, how old you are. You had mentioned as far as kind of beginner, goal, intermediate, and long-term, and depending on, I guess, the stage of your life and kind of where you want to kind of be, if you own a business or you're working in a corporate job, and where you want to do. And then it's because you can't just say, hey, I'm just going to buy real estate or utilize debt and stuff. It's like a lot of different small nuances, which, traditional, people won't think of just buying a piece of real estate and that's going to solve your problems. So I guess just finding like the small, minute details in order to kind of make that broad plan. And then you're able to kind of formulate your team that can put everything together. So that's absolutely key right there.
Yeah, no, let me just build on that. And thank you for saying that. Is number 1 in the 7 wealth building rules is to establish goals. And that's pretty common, right? For people that are listening to this podcast, they probably heard that before. But 2 thoughts is you want to write them down. That's conventional wisdom too. But the other thing I think is a little bit underutilized or isn't talked about enough is to think short, mid, and long term. And so I'll give you an example. I was recently referred to someone that was not a real estate investor, but their stated goal was to generate enough income from real estate properties to allow them to leave their corporate job. And they were making, I think it was somewhere around $250,000 a year. And so they figured they were going to need, I forget the number of properties, but let's say it was 25. So that's a great long-term goal, right?
Mm-hmm.
But if you don't break that down into bite-sized pieces, I think sometimes just focusing on the long term could be uninspiring, because there's a lot that has to happen for her to be able to achieve that goal. So if she thinks long term, but then also allocate some time and planning, thinking about short term, a good short term goal for her would be, well, let's buy one property in 2020. Let's get your first property. Or maybe even before that, Dwaine, let's establish what type of property you want to buy, because she wasn't even sure whether she wanted single family home, residential, multifamily, commercial residential, commercial office space. You know, the goal of having real estate is great, but with your experience and having had so many fantastic guests on your show, there's a lot that needs to go into how you're going to carry that out. So have a good long-term goal, but then think short and midterm. What are short-term goals that could help you achieve the larger long-term goal? I would almost say, and I actually will say, that if I had to choose between a short-term goal and a long-term goal, I'd rather pick a short-term goal, because it's more into my control and have the sense of urgency of what I'm going to be able to do this quarter and this year, as opposed to 20 years from now, I want to have 50 properties and be wealthy.
Absolutely. And then kind of keying into that, because then you understanding, your goals there kind of leads into the educational route, which you had mentioned, which type of property it may be. It may be, single family, fix and flip, maybe, multifamily, larger syndications, or commercial single tenant stuff that we, primarily deal with. What are kind of some of your advice as far as kind of, starting that process? Of course, education is the key, but is there any kind of steps that some people should take that can be helpful?
I think be prepared is a good motto, and that's number 2 in the 7 wealth building rules for real estate investors that I have, is be prepared and get educated. And you want to take your time, and that could mean different things, because how much time? But I think that the real estate markets, and I'm going to assume you agree with me, I mean, it's a competitive space, and there's a lot of sharks in that space. I don't mean that in a bad way. I mean that like in a positive way. So you don't want to go rushing into that market without being prepared, because you will get chewed up and spit out. So you do want to take your time. Now, when I say take time, you don't have to take 5 or 10 years, but there's a lot of seminars and education out there for real estate investors. And sometimes people go to a seminar, and next thing you know, they're in a real estate deal the week or 2 after. So you want to be educated and do your homework. As you be prepared, do your homework so that you can make a smart decision with your money and your time as you enter into real estate. You're going to make mistakes. There are going to be obstacles. If you own real estate already, things don't work out, whether it's a home or a real estate investing property. Things break, things come in over budget. There's rules, regulation, taxes. If you're dealing with tenants, surprise, surprise, those don't always go wonderfully well. So you want to be prepared in what you do your homework, get educated. And that does tie into what we talked about before with number 4 is building a team. Also lean on your team members to help you. If you're looking to buy a property, having a quality real estate agent that can help you, that is looking out for your best interests and is knowledgeable in the area you're looking, including the type of property. Don't use a residential real estate agent if you're buying commercial. And don't use a commercial real estate agent when you're trying to buy your residential home. So be prepared. And I think the real estate investing industry does a great job. There's a lot of education. There's a lot of wonderful speakers and courses and boot camps and books. And I think that's wonderful. I do think sometimes, though, some of that material overlooks the idea of it takes time to be prepared and getting educated in homework. It's not easy. So I would just urge people not to rush in, but to get started today. You could certainly increase your preparedness today if you want to invest in real estate. And that's something that I think we could all do in trying to get ready to make 2020, because we are recording this in early 2020 to get ready to have a prosperous wealth building 2020.
Absolutely. One of the big things I get when I'm talking with new investors and we're kind of, putting together a plan of what type of investment property, finding out kind of what their returns that they're looking for is the question of utilizing debt. And like I said, most of the time when they come to that question, I ask them, we need to also include other team members such as your CPA and your financial advisor to see based off of your particular goal, is that something should you utilize them? Of course, you can use debt to really build a large portfolio, but you need to be very smart about that. You have a very interesting take on that. Would you kind of elaborate that?
Sure. I think it would go under the heading, this is number 7 of the wealth building rules, is be careful with debt. And let me start by saying that most listeners, most people involved in real estate are familiar with Robert Kiyosaki, who wrote Rich Dad, Poor Dad, one of the most influential business books of all time. And he is a big fan of investing in real estate. He's also, it seems to me, a big fan of using debt. He says good debt, but using debt. And on the other hand, on the other end of the spectrum, there's Dave Ramsey, who also wrote a very influential book, The Total Money Makeover. And Dave Ramsey is literally the poster child for don't use debt. His position is so strong that he would even say he would prefer you not take on a mortgage and save up and buy a house without any debt. And so those are, to me, the two ends of the spectrum, Dwaine. And my view is a little more nuanced. I think some of what comes out of the Robert Kiyosaki school of thought is too liberal with the use of debt and not careful enough about the dangers of debt, because debt magnifies gains, which is exciting when you use other people's money, OPM, but it also works in reverse. And you could easily blow yourself up or swamp yourself if you have too much debt. When you have debt and bad things happen, you are vulnerable. And when I buy real estate, and probably when you want to buy real estate through your syndicate, you want to buy from somebody that's motivated to sell, right?
Mm-hmm.
Because they need to get out and they're going to have pressures on them. So you might be able to get a good deal. Often the person that's the motivated seller is motivated because of some constraints over their debt service. Not always, but typically. Because if you own a property free and clear, why would you be a motivated seller?
Right.
So I think you need to be careful with debt. On the flip side, contrary to Dave Ramsey, I think debt can be used constructively to enhance wealth building activities. Having a first mortgage, I think, is good. Using debt to finance investment properties, I think, is good. But I do believe people just need to be careful and to be aware of the benefits of using debt, but also be aware of the dangers. And I would suggest, as you build a portfolio of real estate and as you become wealthier, you want to be even more careful of debt. So in my own experience, Dwaine, I use debt to acquire several properties, and I have a small portfolio that's comprised of residential and commercial properties. So I have an office building, 2 office buildings, some multifamily units, that kind of thing. It's a small portfolio, but I don't have debt on my properties anymore. Now, I didn't always have that. So I did use debt. But I tell you what, now that I don't have debt on those properties, it does change the way that I look at risk, how I look at the properties. The cash flow calculation is way different than I don't have the debt service.
Mm-hmm.
And when unexpected bills come up or hard negotiations with tenants, I feel much more empowered because I don't have to worry about how I'm going to pay the mortgage.
Mm-hmm.
So we could have probably a whole episode on that. But I would just say in summary, I'm not in the Robert Kiyosaki camp where I believe debt is used too liberal. And I'm not in the Dave Ramsey camp that says debt is automatically evil. I think debt could be used, but be careful with it. And one final note, car loans, student debt, credit card debt is not helpful in creating wealth. That's bad debt. And if you have listeners out there that have a lot of that type of debt, I'd be really careful about adding other debt by buying properties, because then that debt load increases the chances you may run into a problem because all those monthly obligations can become really problematic if something negative happens, loss of a job, health issue, a problem with a property or a business. So did I cover that okay?
Oh yeah, absolutely. Yeah, really, really touched all the points there. So yeah, definitely. Thanks
Good,
for
I'm
that.
glad.
And as far another conversation I have, with some of my kind of larger clients is we talk a lot about was diversification. Of course, different asset classes, and then of course you being a financial advisor from different financial products as well, which I think just having a very overall healthy portfolio, which kind of meets all your different goals, not necessarily being all in real estate, but just having an overall healthy financial portfolio that can kind of take you to what your goal. Can you kind of elaborate on that?
Yes, I will say, Dwayne, and I don't know, having been at this for 27 years, a lot of financial advisors that are out there are going to view real estate investing as competition. Because if somebody says inherits X number of dollars and they're thinking about what they could do with that money, if they invested in real estate, that might mean less that goes into a retirement account or a college fund or an investment account that a financial advisor oversees. And I'm very inclined to go along with using real estate to help build wealth. Over my career, having studied this very closely, most people that become wealthy, and it doesn't necessarily even need to be fabulously wealthy, like the richest 1% of 1%, but just average Americans that have built wealth and have a comfortable lifestyle, they've achieved that with some element of real estate included in the mix. So my own personal wealth building plan has always included real estate in some way, shape, or form. So I believe that in a diversified wealth building plan, incorporating real estate makes sense. Now, there's a lot of different ways you could do it. You could buy a condo, for example, and you could do everything. You could find the tenant, screen the tenant, manage the tenant relationship, fix the toilet when it breaks, do the books, do the banking. You could do all of that yourself. That's fine. You could also go into a partnership with somebody where you could split the duties. You can go into a syndicate where you have lots of partners and it's more passive. You can buy a stock on the New York Stock Exchange that is a real estate investment trust that invests in real estate. You could flip houses. You could buy and hold. You could buy raw land that you expect to develop. I mean, there's numerous ways you could play the real estate wealth building game. But I think it's an important part of building wealth. For most people, at the very least, it's home ownership, achieving the American dream, owning a home, and then hopefully paying off the mortgage and having that home be owned free and clear. But I also think that the wealth building process should not include exclusively real estate. And usually it doesn't. Usually you're going to also use investments that include stock and bond investing, typically in 401ks, IRAs, SEPs, college funds. You should have money in the bank to handle an emergency. So you want to be diversified. And the reason why you want to be diversified, I used this term earlier, Dwayne, is you don't want to blow yourself up. If I have trouble in one of my properties in real estate, I'm diversified because I have other properties, including other types of properties. And if all of real estate happens to be doing poorly, I have other assets in other places that will be unaffected by what's happening in the real estate market. And that gives me comfort as I build wealth that I'm not going to blow myself up. I'm mitigating risk by spreading it across a number of asset classes. And as much as I like real estate and believe it's a good way to build wealth over time, there are other opportunities out there. Warren Buffett, as an example, one of the richest people of America, he didn't invest in any real estate. And that works for him just fine. So there's lots of ways to do it. But irregardless of how you want to carry out building wealth, you want to be diversified and not put all your eggs in one basket. And as you go along, Dwayne, and you do build some wealth, that diversification becomes even more important. If you're young and you're buying your first property, your risk probably is going to be more concentrated, right? Because you can't immediately buy 5 properties and you can't immediately have a big fat retirement account, have a property and have a big fat bank account at the same time. You might have to grow into it a little bit, but diversification is your best friend.
Absolutely. And as far as kind of like this goes back to the teammates, well, all of them kind of, come together, but kind of tracking your progress, which is another point on there is kind of, I kind of see it as, meeting with your financial advisor either once a quarter or once every other month, going over your progress, just keeping up to date. Again, if there's any changes or any adjustments, or just kind of keeping up to date and having people like yourself to kind of say, hey, everything's doing well, and just kind of keep you on progress as trying to set out your 5, 10, 15-year goal.
No, it's a great question. So number 6 in my wealth building was be diversified. Number 5 is track your progress. And actually, you did a fabulous episode with Bruce, I think his name was Kirsch, where he talked about doing pro formas for the properties. So I think of the 7 wealth building rules, I think this is the one that is the least talked about. And in my practice at Elliott Wealth, when I work with clients, it's a key part of what we talk about. But have a net worth statement. So you want to build wealth. How are we going to keep score? We want to keep score of your net worth. So there's a couple of ways you could actually do a net worth statement. But in the simplest sense, we want to keep track of your assets. So let's list all of your assets line by line. I have this much in the bank, this much in the 401k. This property is worth this. This second property is worth this. You add up all of your assets and come up with the total number of assets you have. Next, we're going to add up all your debts if you have any. And so we would add up your debts: student loan, car loan, credit card, mortgage on your home, mortgage on investment property, business loan, whatever the case is. Add up all of your liabilities and come up with a total debt number. Your net worth is calculated by taking your asset total and subtracting out your debts, your liabilities. That number is your net worth. So when you're playing the wealth building game, and people that are buying real estate, they're trying to become wealthier, to do better for themselves and their families. You want to keep track of that progress. The ultimate score in the realm of money is your net worth increasing? Now, if I meet somebody that has 10 properties, I'm impressed. To accumulate 10 properties or 20 properties, that's pretty good. I'm encouraged. That's an accomplishment. But what if I change it a little bit and I say the 10 properties have debt of $1 million and are worth $1 million? There's no net worth there. There's no net worth there. Then that sounds to me like 10 headaches. You have property, they have no wealth in them. Now, they could be cash flowing, and it could be a temporary situation. It could be something where it's an opportunistic investment where the places are going to get fixed up. But I want to keep track of my net worth. So Dwaine, for years, I've kept track of my net worth. I do it quarterly. I would recommend people do it at least annually. And it is very inspiring to see your net worth increase over time, because that means that I'm being wise with money, that I'm winning with money, and that my wealth building plan, incorporating the different elements, is on the whole successful. It doesn't take much time to do the net worth statement. I mean, it takes me 10, 15 minutes every quarter, but it's good. Now, there's really only 2 things you could do to increase your net worth. If we cut out all of the noise and all of the data and information and opinions that are out there, the only way to increase your net worth, well, the 2 ways I should say to increase your net worth, is you're either going to increase your assets or decrease your debt. Now, there's different strategies and how you're going to do that and the timing of each and where to focus. That's part of the planning process. Number 3 in my 7 wealth building rules is to develop a wealth building plan. But in terms of your tracking your progress, keep track of your net worth statement. Because if you buy a lot of properties, but your net worth is not increasing, you want to be aware of that and you want to fix that. If you have money invested in investments, 401ks, IRAs, like we talked about before, they should be going up over time. So you want to have a net worth statement. I think for businesses, you should have a P&L, profit and loss statement. So for a business, you would want to look at your profits and your losses. How much income came into the business? How much went out in expenses? And when you run that calculation, you determine how much of a profit or a loss you have.
Mm-hmm.
Now, I say business. If you own a property, you should do that for the property. If you own a single investment property, I think at least each year you should run a profit and loss, a P&L statement on that property. Did you make money on the property? Not what it's worth, but did you make money? Did you bring in more income than you paid out in expenses? This is what you and Bruce talked about in that excellent episode, because he even talked, Bruce, about doing one pro forma, which means what you expect the profit and loss to look like over a period of time.
Mm-hmm.
And if you do what Bruce counseled, later then you can compare actual results to your expectations.
That's right.
I think that's wonderful. At the very least, you ought to at least look at what actually happened so you could figure out whether you're making money or not. I find a lot of real estate investors don't do that because they buy a property and then they're often off to the next adventure. But here's what happens if you don't do the P&L. What happens if you buy a couple of properties and you have one property that does wonderfully well and the second one does badly, but you can't tell because the first one's gain is subsidizing the second one's losses? I would want to know that. So if I have multiple properties, which I do, I want to have a P&L for each of the properties. I want to look at them individually as a business to see how they're doing as a standalone property. Additionally, along the lines of what you and Bruce talked about, I want to look at how the real estate does together because it is a team and I have diversification in my real estate to look at one P&L for the several properties. I think if you do both, it's a good way to track your progress. And I'll say as an example, Dwaine, a couple of years ago, I had bought a property and I did a bad job buying the property. I paid way too much. Then I complicated or compounded, I should say, my mistake by doing a lousy job managing it. And after looking at the P&L and looking at this property, I realized that my other winners were subsidizing this loser and I sold it and I took a loss. And I know you're not supposed to say that, right? Because everybody comes on real estate investing podcasts and they always make money. I won't say always, but you know, I'm very honest. That was a big mistake and I've made other mistakes. But selling that property at a loss was one of the smartest things I did because once I got over that loss, I had the winners left. But if I wasn't tracking my progress, it could easily have been masked, the loss in that property, because it was being subsidized, not really from money like out of my pocket and out of my checking account, but it was being funded out of my operational LLC real estate account. So you want to track your progress. The net worth statement is crucial, regardless of whether you're a real estate investor. And if you're a business owner and a real estate investor, you should have a P&L for that business and for the property. And then I think the last key element to tracking your progress for me is to have an income statement. Most real estate investors believe in the concept of multiple streams of income. So I have my business that generates income. I have other investments that generate income. I want to have an income statement. I want to have on paper or on a spreadsheet or in QuickBooks. I want to have a place where I could see where my income is coming from. What's my total expected income and where are the income sources? Property 1 generates X in income. Property 2 generates Y in income. My job generates X in income. I get so much from Social Security if you're of that age. If you're getting a pension, if you get alimony, whatever the case is, look at where your income sources are. So if you're tracking your net worth, I think you're way ahead of the game. If you're keeping track of a P&L for your business or businesses, you're way ahead of the game. And if you track where your income is and how you're going to grow that income, you're way ahead of the game. I think far too many people are in the midst of doing stuff that sometimes they don't pay attention, oftentimes don't pay enough attention to tracking their progress to see if their work and the treasure they're putting into these enterprises are actually paying off. The net worth statement, the P&L, and the income statement will make sure that what you're doing is working over time. So I think that's absolutely crucial. And that's probably of the 7 wealth building rules, the one, if your listeners only listen to one commentary from me, it would be the track your progress.
Awesome. Yeah. And like I said, that kind of rounds it out perfectly. And I think there was just one, and Rich was just kind of the beginning one of being prepared, Rich. I kind of left that one for the last one because it's, you're going to go into this endeavor. You got to have a lot of stuff to think about. You're going to get together with your financial advisor or your other team of advisors, and just going to prepare yourself as best as you can. Again, the financial statements, the income statements, all of those is important elements. You just want to make sure that you're properly prepared as you go into this venture. So regardless if you're listening to this podcast, you're 20 years old or you're right heading into retirement, you just want to make sure that you're properly prepared moving forward. You have all your elements in place, and just take action by just getting an education, speaking to people like yourself, Christopher, and others, just to kind of get that overall, education and, angle to move and kind of get things started, or adjusting that you may have been doing that like you had mentioned with the property, that maybe you need to sell it. You'd want to know that until, you actually dive in and get really detailed with your stuff.
Yeah, if you're investing in any business, if you're in any business, and I know a lot of your listeners are entrepreneurial, small business owners, I mean, stuff happens, you make mistakes, but recognizing mistakes and fixing them or stop doing the mistakes, I mean, that's really, really important. And sometimes it could be difficult when you're in the trenches, that you may miss out on that. So I tell you, I met with one other person. I flipped about 10 houses. It's been a long time since I flipped a house, but I met somebody recently, and they're flipping houses, and they bought the first one and they sold it at a loss, and they bought two others which they haven't been able to sell, and they're getting ready to buy their fourth one. So my counsel, I don't want to, because it's a young person and I admire their enthusiasm and their attempt to do something special and do something hard and to make money. I mean, I think that's so amazing. So I don't want to drown their enthusiasm and their goals, but that seems really dangerous, to be doing the fourth one when the first three didn't work. Now, I'm not saying don't do the fourth one, but maybe not do the fourth one yet. Maybe do an autopsy on the previous three to figure out, what did you buy it well but not manage the project well? Or did you buy it poorly and then really manage the project well? Those two different scenarios are significantly different in what you'd want to do moving forward to achieve better success. So that's what we're talking about in terms of tracking your progress and being prepared. The last thing I'll say, the one of the 7 rules we didn't touch on is to develop a wealth building plan. So if you'll allow me, is if you take the simplest thing, if you make X number of dollars, there's so much of those dollars each year that you want to allocate to wealth building. So what are you going to do with that portion of the money? Is it going to go to real estate? Is it going to go to debt reduction? Is it going to go into your 401k? Is it going to go into the bank to build up your emergency fund? That's a good basic wealth building plan. We're at the beginning of 2020. If you look at your income, figure out what you want to do with that money that increases wealth. There's a lot of ways you can increase wealth. It could be as simple as pay off a credit card. I know that's not as sexy and as exciting as buying a apartment building and involved in a syndicate that's going to develop a condo development, but maybe that makes sense. But have a wealth building plan. In terms of real estate, have a wealth building plan. What do you want to buy? I've learned over the last couple of years that there's certain areas and certain property types that are not really for me. There's nothing wrong with them. They're not really for me. I invested in one particular town. I won't say it because we're neighbors. And, it looked great when I spreadsheeted it, but it really didn't work out for me. It wasn't my community. I didn't have a good pulse on it. And we talked about sharks at the beginning of the conversation. I got chewed up. It didn't really work well on several of the things. I didn't get hit too badly, although that bad property was in that same town. So I've learned over years what works for me. So my wealth building plan, I know what I want to buy, how much I want to buy. And the other part of the wealth building plan in terms of real estate is to have an end game. If you buy a property to flip and you own it for a long time because you couldn't sell it, that's a problem with your wealth building plan. It may turn out okay, but you do want to have a plan. And so if you buy a property and realize that you can't find good tenants and you sell it, that's not a good plan either. So I think you should develop a wealth building plan, how you're going to allocate your resources, your assets, your income, and your time to build wealth. Some of it's passive, like putting money in your 401k. Some of it could be active, like doing the work in a flip. Another good passive one would be investing in a syndicate where you're teaming up with others and getting professional management to help you. But develop a wealth building plan. Usually, Dwaine, what I've learned over 27 years with my personal experience and working with hundreds, if not thousands, it's actually thousands of people, is that it doesn't happen by accident. You do got to put some work into it. You don't need 40 hours a week, but you can't spend more time planning your vacation this year than you do planning to build wealth. You're not going to trip over it. So develop a wealth building plan is the last one. And again, another compliment to you. You and Matthew Baltzell, is that how you pronounce that?
Yeah, well,
You guys did one about staying focused and knowing your investment criteria. This is along the same lines. My wealth building plan, the work that I do for clients though, Dwaine, is not just in the real estate realm. It's more of a macro planning from a household standpoint that we do for clients that incorporates real estate as well as other things like debt reduction, college planning, retirement planning, having money in the bank, estate planning, life insurance to protect your loved ones. All of that stuff is the kind of comprehensive, holistic work we do for our clients.
and that's the biggest thing. And I'm glad you're on the call today. You mentioned holistic is because, like I said, we think about just making money through real estate, but there's a lot of different things. I have kids, and a lot of the listeners have kids and things like that, or same for college or health and medical, and same stuff in the bank. You just have to have an overall plan on different factors, and it just can't be solely focused on one thing. So I'm glad we went through this whole thing because all of those points are perfect, and this, like I said, it's a good thing to kick off 2020. To learn a little bit more about you and kind of your day-to-day operations, what's a typical workday for you, and do you have any special morning routines?
So at this stage of the game, being an entrepreneur and a small business owner, most of my days are atypical. So it depends a little bit on the day. So this time of year, we're recording this in early 2020. Most of my business days are meeting with clients to review 2019, to review how their financial plans evolved in 2019, how their investments did, how their income did, were there any changes on their end, job-wise, family-wise, that kind of thing. And then also we talk a little bit about the outlook for 2020. How do we expect the financial plan to evolve, expected returns, the economy, the markets, their goals and objectives. So, I will have, for example, this week and next, I'll probably meet between 30 and 40 clients doing reviews of last year, including the outlook for this year. So once I'm beyond there, the days change. So I like in my career that I get to help people. It's a very financially rewarding business as well. But it also affords me quite a nice work-life balance. I coach my son's football team in the fall, which means I did less client meetings in the evening, but I was able to rearrange things so that I could have the really special opportunity to coach his last year in youth football as he goes on to high school next year. And I wouldn't want to change that. That was so special and awesome. And I'm not going to get to do it again, although it was exhausting. So my days tend to change, and I like that, Dwaine. Some days I meet with clients a lot, and other days I'm doing more research. Some days I'm on the phone a lot with people, and other days I'm in person with them. Sometimes it's just me in my office, and other times I'm giving a presentation to a large group. I love that change, because if I was in my office all day, I don't think I would enjoy that. If I was on the road meeting clients all day, that would grow tiresome too. So my days are pretty atypical, but for an entrepreneur, that's pretty common, and that really works for me, and I thrive on that. Morning routines, I would say business-wise, there's a number of things I check in the morning that you'd expect. I check the markets, um, emails. When I check those things, I try not to get too into the weeds on them early in the morning because I don't want to get distracted. But I will just kind of get a sense of what's going on. Is there a client that had a tragedy, is in the hospital or passed away? Something that's extremely urgent.
Hmm.
But I'll tell you, one of the key morning routines that I have, which has served me extraordinarily well, is when I come to work, or even if it's not work, a day of leisure, I will write down at work the top 10 things to do in a day. There's lots of demands on my time. You're probably the same, Dwaine. So when I get to work, I list down the most important 10 things that I need to do. The idea in thinking with that is, let's say I get called away from the office for something. If I just did those 10 days, would it still be a productive, successful day? And that helps me stay focused, be efficient with my time, and to make sure that when I'm at work, I'm working, and when I'm at home, I can enjoy my home time and have quality time at home. So
Hmm.
every morning when I come in, the first thing I do is write down the top 10 things that I want to do in a given day. On power days, I'm on a roll, things are going well, I might have 2 or 3 top 10 things because I just roll through them.
Hmm.
Other days I may do the top 10, but something may happen and I may only get 3 or 4 done, or I may be waiting for somebody. I may run into a snag, or I may have to reprioritize because a client or a team member might need something. So I may have to shift those priorities. But doing that top 10, and all of my team here at Elliott Wealth Management, we all do this every day, really increases efficiency, time management, helps me stay focused so that I get as much as I can done while I'm at work, which allows me then when I'm not at work to really enjoy my time away from the office. Is that a good answer?
Oh yeah, beautiful said. Yeah, I always like asking entrepreneurs because, like I said, I just seeing what successful people are doing, and gives the listeners new things that they can utilize so they can improve their daily lives as well. You had mentioned your son in football and things like that. Family is a big thing. What can you say that you're most grateful for?
It's a good question. And on the heels of what for me was a wonderful, wonderful Christmas season, I mean, I'm so blessed. There's so many things you could say, right? There's family, there's health, there's friends, there's financial successes, because that leads to, in many ways, less pressures and stresses, at least in the financial realm. But I think if I would have to say one thing, and I have lots I can choose from, again, I'm very blessed, I would say the love of a very good woman. I'm in a wonderful marriage. I've been married. It'll be 24 years later this year. It's tough being married. It's hard, but the fruits of that relationship, having children, being together day to day, having someone who loves you unconditionally when you come home, is something that I am continually grateful for. So if I had to pick one thing, it would be that. And again, I'm very blessed. I have lots to choose from, but the love of a good woman would be my pick.
Beautiful. Yeah, very well said. Thank you so much. So how do we get in contact with you? You have a website, phone number that you'd like to share with us?
Yes. So my firm, as you said, is Elliott Wealth Management. Elliott has 2 L's and 2 T's. And I would love for your listeners to go take a look at our website, which is www.elliottwealth.com. There you can find more information about me and the team and how we help our clients. And if you're a listener and you'd like to talk with us, we could do a complimentary consultation where we could talk a little bit about your goals and objectives and how we might be able to help you win with money and increase your financial IQ. So you could sign up for that at the website. We could do that in person. We could do a remote meeting, kind of like you and I, Dwaine, are doing today. We could do it by phone. About a third of our clients are in Connecticut, a third are in Florida, and a third are throughout the rest of the country. We're in I don't know, I think 28 states where we have clients in the country. So you get more information there. And I do a podcast as well, Simply Financial. You could find that on iTunes and other podcast platforms. So go to my website and check out the Simply Financial podcast as well.
Beautiful. And also you can find on that website is the white paper that we just
yeah.
reviewed, which is,
Thank you
if
for
you wanted a
reminding
copy
me.
of that. Yeah.
When you go there, prominently displayed on the main page will be the white paper that Dwaine referenced a couple of times, which is an extension of our great discussion today, the 7 rules for real estate investing. And I'll make that available for free. Anybody who wants to go to the website, check it out. You don't even need to put your email or name or anything in there. It'll be, I think we have it set up that way. It'll be free. So please check it out.
Beautiful. Christopher, I really appreciate you. Again, it's a great discussion heading into the new year to get prepared, get this process started, start thinking about real estate investments and other different financial vehicles. So I really appreciate you taking time. Love that you're close by. We're going to definitely arrange a time. We get some coffee or lunch or something like that. And again, Christopher Calandra, of Elliott Wealth Management Services. And again, enjoy the rest of the year, and we'll look forward to connecting with you again soon.
Thanks for joining us on this episode of the Wealth Through Real Estate Investing podcast. Don't forget to subscribe and leave us a review on iTunes or the listening platform of your choice. Also, please check us out at DwaineLClarke.com, as well as find us on Facebook for more useful content and resources.